Good day to all of you. Hi guys. Chapter for today is chapter 26, the fiscal policy, lesson 1. Alright. So under the macroeconomic economics, so we will be learning three important policies. Okay, the first policy will be the fiscal policy, FP, or another name for fiscal policy is budget policy. Okay, budget policy. Then in the following chapter 27, we will be learning on the monetary policy. Okay, monetary policy. And then chapter 28 will be the supply side policy. So I repeat, fiscal policy, monetary policy, and supply side policy. These are the three important government policies that we have to remember, and it is important for you to know in detail what it is and all that. So another name for fiscal policy is budget policies. It's a fiscal policy also known as the budget policy. So when talk about budget, two instruments, two components of fiscal policy that you have to know, or the budget that you have to know, which are the government revenue and government expenditure. Okay, so or sometimes we can say taxation, because tax being the largest contributor to their government revenue. Taxation, and also the government expenditure. So when we talk about the government expenditure, we have two types of government expenditure. One is the current expenditure, the other one is the capital expenditure. So current expenditure, capital expenditure. So when talk about the budget, okay, the first thing that you have to know is the government revenue followed by the government expenditure. Right, so let's go into the lesson for today. So instructions for students. Students are required to do the following: read, watch and do. Read Econ's course book, page 228 and 229 only, as well as the attached notes. Step 2, watch video presentation. This video presentation, lesson 1 video presentation, and do complete the following question. Review questions 1 only. There are about 3 review questions I've attached in these notes. Alright, the purpose for me to attaching more questions is because it may help you in future for you to prepare for IGCSE economics. So for now you just do the review questions 1. That's good enough. But in future, please try out review questions 2 and question 3, which I believe it is very important to try it out. Learning objectives. Alright, by end of this lesson, you should be able to describe budget and types of budget, 3 types of budgets. Budget surplus, budget deficit, and balanced budget. Okay, there are three types of budget. So you also need to know what is budget. Budget means it's a simple comparison. It is a financial, it is a planned record or forecasted value of government revenue and government expenditure for 6 months to 1 year. Okay, for 6 months to 1 year. So this is what you should be able to describe by end of this lesson. And there are 3 types of the budgets as well. It is very simple. By 3 types of budget is very simple. It's by doing a comparison between the government revenue and government expenditure. Government revenue means GR, government expenditure means GE. If GR more than GE, if revenue is more than the expenditure, G is mean government revenue, GR means government revenue, GE means government expenditure. So when GR more than GE, so it is a surplus, it's a positive value for the government. Government made more revenue compared to the expenditure. Alright, so it's going to be surplus budget. It's a budget surplus or surplus budget. The other one is what? Budget deficit. So budget deficit is when the GR is lesser, revenue is lesser than the expenditure. Alright, so there's going to be a deficit or minus value or negative value to the government revenue. So we call it as a deficit budget. The third one, if the government revenue is equals to the government expenditure is going to be balanced budget. So this is how we see. We will look at all this later. So just to give you some ideas, just to throw in some background information on the budget. Other than budget, the next learning objective will be the components or types of government expenditure. There are two important components that you have to remember, okay, or two types of government expenditure, right? One is the current government expenditure, the other one is the capital government expenditure, capital expenditure. I repeat, current expenditure and capital expenditure. Current expenditure is what we call the operational expenditure. So expenditure or spending that has been made to run day-to-day operation, government's operation. All right. Whereas the capital expenditure is going to be on the projects or buildings, highway. All right, the government projects. Okay, to build highways, to build road. Okay, so it's all on the development expenditure. So capital expenditure is all on the development expenditure. Okay, finally, you should be able to explain the reasons for the government expenditure as well as the taxation. Let's go on to the lesson 1 on the budget and the government expenditure. As we discussed earlier, so two important key points that you have to know. One is the GR, the other one is the GE. GR is the government revenue, GE is the government expenditure, or sometimes you can also say government spending. Okay, so in order to spend money, government has to earn money. So government's earning is what we call government revenue. Government spending is what we call the government expenditure. In other words, government's earning is what we call GR, government expenditure. GR or the government expenditure. Government spending is what we call the GE or government expenditure. GE. Yeah? Right. A budget suggests a forecast value. So budget means it's going to be a forecast. Okay, like you and me, we have our own budget. We will budget for the next month, or maybe in a weekly basis. Next week, I'm going to budget this. Okay, I'm going to spend this much. So this many expenses I have, and this much of money I'm going to earn from this many sources. For example, so you will have your planning. All right, you have your planning for finance to manage your finance. Similarly, government also has their planning to manage its finances sensibly. All right, so a budget is a forecast of government spending and as well as the revenue over the subsequent period of time, perhaps 6 months to 1 year, made so that it can plan and manage its finance sensibly, properly. Therefore, budget, we can define budget as a statement where government sets out its annual planned revenue and expenditure. So usually budget is planned, okay, budget is planned in annual basis or yearly basis, not by monthly or weekly or daily basis. All right. So budget, when we talk about types of budget, so this one I'm trying to say the types. I'm trying to explain the types of budget. Okay, by comparing the planned government revenue with the planned government expenditure. Okay, by comparing planned government revenue with the planned government expenditure depending on the economic condition. Therefore, the government budget can be either a surplus or surplus, deficit or balance. Okay, all right. So the difference, how to identify whether a budget is a surplus budget or deficit budget or a balanced budget is based on what? By minusing out the government expenditure, planned expenditure from the planned revenue. Okay, so if you look at here numerically or in a form to show in a formula in an equation form, we can say BB means budget balance. BB means budget balance is equal to the planned government revenue minus planned government expenditure. So let's take a look at this example, a simple example. by a numerical example by comparing 3 different countries. So we have country A, country B, and country C. Okay, so let's say country A, the planned government revenue is about $100 billion, and the planned government expenditure is about $80 billion for the following year. Therefore, the budget balance is going to be positive $20 billion. That means surplus budget. It shows a surplus budget here for country A. Whereas if you look at the country B, the government revenue is 100 billion. The government expenditure is 130 billion. The planned government revenue is $100 billion. The planned government expenditure is about $130 billion. Therefore, the balance budget or budget balance will be a negative value. A negative value means a deficit budget. It shows a deficit planned budget. Okay, deficit of what? $30 billion. Deficit of $30 billion. So if you look at for the country C, for the country C, we can see that the planned government revenue is about $100 billion, and the planned government expenditure for next year is about also it's the same thing where $100 billion. Therefore, if we minus the balance, the budget balance is going to be $0 billion. Okay, therefore it is not a surplus, it is not a deficit, it is going to be zero. If it is zero, we can say a balanced budget. So in other words, we can also describe a surplus budget is when the GR is more than the GE. Okay, if the GR is more than GE, therefore you will get a positive value. Okay, if it is a positive value in BB, therefore it is a surplus budget. Whereas for the deficit budget, we can say GR is lesser than the GE. When GR is lesser than the GE, we will get a negative value of BB. As you get a negative value of BB, we can say it is a deficit budget. Okay, so when the GR is equal to GE, so you get a zero value. Therefore, we can say it is a balanced budget. So next important concept is the national debt. Okay, so national debt or government debt, we can say government debt or public sector's debt. Okay, so how can we define it? It means, what do we mean by national debt? It is the total amount of money borrowed by the government. Okay, it can be locally or internationally over a time period that has yet to be repaid. That has yet to be repaid. Okay, it's called the public debt or national debt. So what is the relationship between the budget and the national debt? Okay, so when there is a surplus budget, okay, types of budget comparing the relationship between the types of budget and the national debt. Okay, so like you and me, when we tend to borrow money whenever we have shortage of funds, whenever we don't have enough funds. Okay, whenever we don't have enough money, we tend to borrow. Okay, human tends to borrow. Similarly, government also, okay, sometimes they tend to borrow whenever they face a deficit budget. Whenever they face a deficit budget. So now, in this case, you can see, for example, a surplus budget means there are excess. We got extra funds. We got more funds. So what the government will do is the government will use the extra funds to repay the government's borrowing. Alright, okay, in order to reduce the national debt. Okay, whereas whenever a deficit budget, it suggests there is a lack of funds. Okay, insufficient funds to meet the current spending. Therefore, the government compelled to do borrowing. So this may increase the national debt. So these are the relationship between a budget and the national debt. So next, let's move into the government expenditure. So as we discussed earlier, so there are two types of government expenditure that you have to know. One is what we call the current expenditure or operating expenditure. Okay, operating expenditure or operational expenditure. Okay, the other one is the capital expenditure or development expenditure. Okay, all right. So government can be in the previous chapter we discussed that what government as a producer, government as an employer. Okay, government also as a consumer. Okay, so government also is a user where the government tend to do what expenditure. So public sector expenditure accounts for large share of the total spending in many economies, right? So government is the biggest consumer, the largest consumer in many countries. Okay, so its total spending is what is called as the public expenditure or government expenditure. We can use the symbol GE for government expenditure, or commonly used is the G as the government expenditure. So as I told you, there are two types of expenditure. The current expenditure. So current expenditure means day-to-day spending. Government's day-to-day spending. All right. So it is a recurring spending on goods and services in the day-to-day running of the government machinery in the current financial year. Right. So the expenditure that planned to run the country for day-to-day expenditure. Alright. Okay. So these are such as what? Paying salaries and wages to the government servants. Alright. Civil servants or the government servants. Okay. In order to purchase, consume supplies for maintenance of the public sector, or running cost of the government offices. Alright. Running cost of the government offices, to pay pension and what? Welfare payments or other transfer payments. Right. To what? To bear on the state pensions, government pensions, welfare payments, and also other transfer payments. Whereas if you look at the capital expenditure, another name for what? Capital expenditure is what we call the development expenditure, or capital expenditure are the investment on new projects. Alright. Okay, such as building schools, hospitals, highways, flyovers, dams, bridges, and other infrastructure. Right. So infrastructure development. Okay, and as well as the other infrastructure. So expenditure on that is what we call the capital expenditure of the government. So government expenditure is very general, so we can break it down, or we can specify as the current expenditure, and the other one is the capital expenditure. So review questions. Please do these questions. So continue on the capital expenditure. So public sector spending or the government spending, G, is an important component in the aggregate output or GDP. So as we discussed earlier, right? So AD is equals to C plus I plus G plus net exports. Yeah. So G is the government's expenditure. So when government expenditure is what? Is positively related with the aggregate demand. Aggregate demand is also positively related to the national output. More AD, more output. More output, more growth. Right? Okay, higher the AD, higher the national output. Therefore, G is going to be one component of the AD. As the G increases, the AD increases. As the AD increases, the Y increases. So Y means the national output, the income, national country's income. AD is the aggregate demand, and G is the government expenditure. Okay, so other than that, the investment in infrastructure projects such as transport and communication industry tend to create external economies of scale. Okay, but as the government did the expenditure, okay, especially on the infrastructure development. Okay, the better infrastructure development, okay, reduces the cost of production for firms. And this increases the companies in the countries, okay, in our country, companies in the country to make more profit. Okay, to make more profit. Okay, let's move on to the next subtitle on the reasons for government spending. So there are about a total of 4 important points that you have to remember on the reasons of government spending. The first reason here is to influence economic activity, to manage the economy. Next, to reduce market failure and safeguard public interest. Okay. The third important point that you have to remember is what? To reduce the inequalities and promote equality, or we can say to reduce what? The poverty level. Okay, to reduce the gap between rich and poor. We can also say the government would like to spend because to reduce the income gap between the rich and poor. Okay, that will be the third point. The fourth point is, of course, to what? For the purpose of debt servicing, or to repay, to pay interest, as well as the capital, the main debt of the government. All right, to mainly to what? To manage the debt, to do the debt servicing. Okay, so these are the 4 reasons. I repeat: to influence economic activity. Okay, that's the first reason. The second reason is what? To reduce market failure. The third reason is to what? To reduce the income gap between rich and poor. The fourth point here is the debt servicing. Okay, debt servicing, to pay interest on the national debt. Okay, right. So the first point here is what? During economic recession. All right, during economic recession, the government usually will increase their spending to purposely to increase what? The aggregate demand. Okay, whereas during the inflationary period, the government will what? Will cut down the government spending to reduce the aggregate demand. Okay, all right. So the government can adjust. All right, the government can adjust the government expenditure in order to what? Solve economic issues such as inflation or unemployment. All right, or recession. So during economic recession, so government need to boost the national output and also to create more job opportunities. What the government will do is the government will what? Increase its spending to purposely increase the aggregate demand, where as the more aggregate demand will create what? The national output. It will lead to what? More supply. As there is a more demand, this will create more employment opportunities and reduces the recession in the country. So this will result in what? Economic recovery. This will result in economic recovery. Secondly, to reduce market failure and to safeguard the public interest. So in order to reduce the market failure, the government intervention is mainly to provide the public goods as well as the to supply more on the merit goods, right? So public goods such as street lights, public defense and other are not financed by the private sector due to their special features. Hence, similarly, merit goods such as education and healthcare also not sufficiently provided by the private sector. Therefore, the government spend money in direct provision of mainly the public goods, and also to increase the to reduce the shortage of the merit goods, right? So what the government will do, the government will supply or finance on the production of the merit goods in order to increase the production of the merit good, which is underproduced and underconsumed, which causes the market failure. So next, if you look at the third important point is what? To reduce inequalities and promote equality. Okay, or to reduce the income gap between rich and poor. So income gap between rich and poor exists. Okay, therefore, poor people gets poorer, rich people gets richer. Okay, therefore, poor people is known as the vulnerable group. Which are like low who earns the society or the one particular group or the community which earns lesser income or old age, as well as the children who are in the need of help. Okay, so the government will provide support in the form of what? Income, welfare payments, and as well as the other benefits. So these payments is what we call as the transfer payments, which is simply transferring money collected through the taxes from rich people. Okay, from what? Rich people. So transfer payments include transfer payments such as pension and grants, unemployment benefits or compensation, child support program, and subsidies on housing and education. Next, if you look at the fourth point, is to what? To pay interest on debt. As the national debt exists, okay, when the borrowing is done due to gap between government spending and government revenue, okay, whenever the government revenue is lesser than the government spending, therefore the government are compelled to do borrowing, which will increase the national debt. So in order to maintain the national debt, okay, to avoid an increase in the national debt, the government will do debt servicing, okay, by paying interest on the debt. So debt servicing is part of the current expenditure of the government or the operational expenditure of the government. So debt servicing is what? Is one good example of a operational expenditure or current expenditure. So review questions 2 on at glance. Optional. It is not compulsory for you to do this, but it is. I encourage you to try it out in future. If you think you have if you think you have enough time to try it out, please go ahead. So next, reasons for imposing tax or levying taxation. Okay, the government not only do the expenditure, but the government also will impose taxation or levy tax. Okay, on this is mainly to reduce. Because mainly of the 4 problems. The first problem is because of the income gap, widening income gap between the rich and poor. The second is what? To discourage demerit good. Okay, to discourage the production and consumption of demerit good. Number 3 is what? To reduce or to slow down little bit of the economic activities which leading to inflation. All right, economic activities, more economic activities or higher economic activities in a country is good, where it will stimulate economic growth. It will increase the national output, as well as what? Employment. However, it is also increases inflation in the country. So in order to control inflation, what the government needs to do is the government need to tax, to impose tax and cut a little bit on the government expenditure. Okay, we also got what? Other problems that we have to other problems such as the market failure. So market failure, in order to overcome market failure, so the government has to tax. So let's take a look at the first point, the income gap. So income gap, if you look at the description for the income gap, you can say rich pay more tax. All right, poor either pay no tax or lesser tax compared to the rich. This is simply, and the poor receive what? The vulnerable group will receive the transfer payments. Okay, this is simply to bridge the gap between rich and poor. This is to reduce the gap between rich and poor. This is to promote the equality. All right, between the to promote what? Equality. So, and this is what we call as the redistribution of income, one of the macro aim of the government. Okay, second, demerit goods such as cigarette smoking, liquor or alcohol consumption, okay, may have the harmful effect on the society. Okay, therefore to discourage the consumption and production of the demerit goods, the government imposes tax on the production and consumption of the demerit goods. Okay, number 3 is what? During a period of high level economic activities, okay, the total or aggregate demand is high and the overall price level increases, will cause inflation in the country. Alright, in order to curb inflation, the government may increase the direct tax, mainly the direct tax, resulting in what? Lower disposable income, lower AD, therefore the price stability can be achieved this way. Okay, so too much of economic activity may lead to what? Inflation, price hike in the general price level. In order to control in order to ensure low and stable price, general price, the government has to impose tax or levy more tax and reduce government expenditure in order to bring down the general price level by reducing the government expenditure and increasing the tax. This may reduce the people's disposable income. As people got lesser disposable income, lesser total demand or lesser aggregate demand will bring down the national output, will bring down the general price level. So other issues such as what? Overproduction of companies can cause what? Pollution and environmental damages. Okay, to overcome or to reduce overproduction, okay, or to overcome what? Pollution, or to reduce pollution and environmental damages, the government may impose tax on companies. Okay, right, and also to what? Curb imports. Okay, imports, to reduce imports, right? So the government also may tax, indirect tax, or like custom duties or tariffs on companies that which involve in imports of raw materials and final goods. So that's all for today. Thank you very much. See you in the next lesson.